Hello, my name is Magnus Petersen. This talk is about the S&P 500 and it is based on this book, and you can click on the image or the link below the video. The S&P 500 is a so-called stock market index, and it consists of the stocks of 500 large companies in the United States. It covers about 80% of the entire US stock market in terms of size. It started in 1957 and is the oldest broadly diversified stock index. The Dow Jones Industrial Average is much older, but it is only for 30 companies and is not as diversified as the S&P 500. You can invest in index funds that closely track the performance of the S&P 500. This allows you to get very broad diversification at a very low cost. This should give you good returns over time, but the S&P 500 may be very volatile in the short term. So let's look at a few of the companies in the S&P 500. And this is from April 2015. The companies are weighted by their market capitalization, which is the market value of all the company shares. So it is the number of shares multiplied by the price per share. Apple is the largest company with a market cap of $740 billion, which is 4% of the S&P 500. ExxonMobil is the second largest company with a market cap of $356 billion, and this is about 2% of the S&P 500. Microsoft is the third largest company, and the market cap is $341 billion, which is 1.9% of the S&P 500. Pfizer is the 10th largest company. The market cap is $211 billion, so it is 1.1% of the S&P 500. The smallest company in the S&P 500 is called Diamond Offshore Drilling, and it has a market cap of $4 billion, which is about 0.02% of the S&P 500. So the S&P 500 gives you very broad diversification, which protects you from problems with individual companies or industries. For example, if you invest $10,000 in the S&P 500 and the smallest company goes bankrupt and their stock goes to zero, then you only lose $2. If the largest company, Apple, goes bankrupt, then you lose $400 on your $10,000 investment. But the opposite is also true. If a single stock performs really well, then you only gain a little. For example, if the stock price of the smallest company increases tenfold, then you only make $18 on your $10,000 investment. Between 1962 and 2013, the S&P 500 returned 9.7% per year on average, assuming dividends were reinvested and there were no taxes. If we adjust for inflation, then the return was 5.4% per year on average. And this means the inflation-adjusted value doubled every 13 years. But the S&P 500 is highly volatile and lost half its value in 1 year and gained 70% in another year. The longest recovery time after a crash was the so-called dot-com bubble in year 2000. It took more than 6 years to recover. So what are the causes of growth for the S&P 500? As we just saw, it returned 9.7% per year on average between 1962 and 2013. Some of this return was due to reinvestment of dividends. The price of the S&P 500 grew 6.4% per year, and the earnings per share of the companies in the S&P 500 grew 6.45% per year. So the price grew almost the same as earnings, and this is what we would expect over a long period of time. The gross domestic product of the United States measures the economic activity in the country, and that grew about 6.7% per year on average. We would expect this to be about the same as the earnings growth for the S&P 500 because the companies in the S&P 500 are some of the largest companies in the United States. The inflation accounted for 4.0% of this growth. So most of the economic growth was not due to economic activity increase, it was actually just due to inflation. The US population grew about 1.06% per year in this period, but the productivity of each US worker increased 2% per year, and this means the productivity of each worker doubled about every 35 years. We can expect the inflation to continue in the future. It might only be 2.5% or 3% or 3.5%, but it is probably going to continue in the future. The US population is expected to grow at, I think it's 0.5% per year. The most important factor is the increase in productivity. So the key question is, will this continue in the future? And this depends on technological innovation, which has driven the productivity increase in the past. So how do you actually invest in the S&P 500? There are different ways of doing it. You can invest in a mutual fund from companies such as Vanguard, but these may require you to invest an initial amount like $3,000. If you cannot afford this, then you can invest in an exchange-traded fund, which can be traded like a normal stock through a stockbroker. Examples of ETFs for the S&P 500 are VOO, SPI, and IVV. However, it is very important that the fees and expense ratios are very low, and you should see my other talk on this subject. Very important. So the conclusion is that the S&P 500 consists of the stocks of 500 of the largest US companies. It can be very volatile in the short term, but the broad diversification gives you good returns over time. You should invest in the fund with lowest expense ratios. You should also keep some of your money invested in short-term US government bonds in case you have an emergency and the S&P 500 has crashed. I have other talks on these subjects, and you can also see more details in the book. You can click on the image or the link below the video.